Vasu Menon, Vice President for OCBC Bank Wealth Management, joining us now from Singapore. Vasu Menon, thanks a lot for joining us. Let's just talk a little bit about where we are and the recent declines that we've seen, particularly in Asia. Do they represent a buying opportunity?
Well, I think, we're not telling people to buy outright in the market. We still see the possibility of further downside. We can't discount that because, there's so many headwinds in the horizon. Another 10%, 15% downside cannot be ruled out, depending on how things play out in Europe. So what we're saying is go ahead and buy in case you missed the boat, but buy gradually, spread your investments out gradually over the next 12, perhaps even 18 months. In other words, stagger your purchases. This is not a market where you can time the market. It's extremely tricky.
Now, we're seeing Asian markets really at the moment price in a default, perhaps even for Greece, and also at the moment a slowdown in the US. Have they, do you think, gone down too far too fast?
Well, Asia tends to be a risky bet, and when the market's on a downswing, you could see Asia overshooting on the downside. So while the fundamentals for Asia are fantastic, the economic growth in Asia is strong, valuations are excellent, fundamentals are good, and, essentially affluence in Asia is growing and economies are doing well. So the story is good, the macro story is good. But the problem is that, I think Asian markets are not as liquid as what you have out of developed markets. So on a downside, the markets could overshoot. So I would say that Asia is a good buy. But once again, still, the best thing to do would be to stagger your purchases. Buy on weakness, buy gradually, buy in drip feed into the market.
Well, as we've seen this retreat in global equity markets, it's been quite surprising that on this down leg that we haven't seen the price of gold shoot up. What's the story there?
Well, gold did shoot up. It did go up to, about $1,920 an ounce. It's pulled back. It's got a bit crowded because it's done extremely well over the last couple of months. We're seeing a bit of profit taking. But I think the other thing that's weighed on gold prices over the last couple of weeks has been the US dollar. The US dollar has been strong. Risk aversion has been on the rise, and that's benefited the US dollar. And clearly, when US dollar strengthens, that weighs on gold prices. But we are positive on gold for the medium term. We still see gold prices heading higher. We are optimistic that gold will hit past the $2,000 an ounce over the next 12 months. So gold is a good buy. This weakness in gold prices, we see it as an opportunity for investors to buy.
That's medium term. What about short term? Because I think that you've got a theory here that we could actually see further weakness.
Possible. If the US dollar continues to strengthen because of what's happening out of Europe, yes, it could weigh on gold prices. Gold could hit below $1,800 an ounce. It's very close to that level anyway. And on that kind of dip, I think it presents an even more attractive buying opportunity. So short term, yes, you're right. Gold could, be very volatile, possibly even hit south. But we see that as a buying opportunity because the long-term prospects for gold are very promising. Investment demand for gold is on the rise. Central banks are diversifying their reserves away from the US dollar. And gold is one asset class that they are investing into. And we see a strong case for gold to hit higher.
Yeah, so we have seen, of course, the dollar strengthen of late. Isn't that really been more of a function of euro weakness more than anything else?
Definitely. The Federal Reserve has said that it's going to keep interest rates low for the next 2 years. So clearly, it's not a yield story anymore. It's clearly because of what's happening out of Europe. And in the U.S., fundamentals are not fantastic. The U.S. is still a huge fiscal deficit, huge amounts of debt. Politicians there are bickering, probably not as much as what you have out of Europe, but still problems there. But on relative terms, the U.S. is not looking as bad as Europe, and that's benefiting the U.S. dollar. So this U.S. dollar strength may not last. It may go on for a short while more, but when things start looking better in Europe, the US dollar could weaken.
But, I put it to you that actually isn't the dollar strengthening because there's essentially a pricing in of there being a lack of, or should I say, a discounting of any further quantitative easing.
Yeah, you're right. Perhaps when, come September 20th, 21st, the Federal Reserve does announce some form of quantitative easing, it could weigh on the dollar. We saw that happen last year when QE2 was announced. But, somehow I think markets are saying that the Fed may not do anything as dramatic as what they did with QE1 and QE2 because QE1, QE2 has not produced much results in the first place. So the Fed knows it's got to do something different. And, perhaps they won't do anything too drastic. And so on that note, it could actually augur well for the dollar.
Yeah, well, what did you make of the 2 rounds of QE we've already had now? Do you think that they produced the results in any way, shape or form that was the intention?
Well, I think it's helped to stem a prevent a financial crisis. I mean, if they didn't launch QE1, we could have, gone into a deep recession, perhaps even a Great Depression. So the Fed did the right thing with QE1, but it's not produced a huge amount of results in terms of, getting the economy back to where it was in 2006, 2007. The job market has not picked up as much. Yes, the financial markets have benefited. After QE1, financial markets rallied for about 1 year and 3 months. QE2 helped to keep the momentum going to some extent. Yes, we saw some job growth initially, but that's kind of tapered off. And stock markets rallied for about 8 months. So I think the form of QE1 and QE2 cannot apply at QE3. I think the Federal Reserve has to think of something probably more innovative, So it'll be interesting to see what they do come September 21st.
Vasu, let's just talk about your ideal asset allocation in a portfolio. How would you actually be spreading the risk?
Well, I think we're still positive in equity markets. We still feel that, if for investors with a strong risk appetite, perhaps even as much as 60-65% of your equities, of your portfolio should be invested in equity markets because valuations for equities are not expensive. We feel that economic growth, yes, it will be subpar, and markets will come to accept the new normal. There's a huge amount of liquidity sitting on the sidelines. So the story for equities is still positive. The macro picture is not fantastic, but companies are still able to deliver earnings. Companies are sitting on huge amounts of cash. Apple, for example, in the US, sitting on huge amounts of cash. And you've got so many other companies like Apple here in Asia as well, which is sitting on sizable amounts of cash. So I think, the story for corporate Asia, even corporate America to some extent, is there. So equity markets are the way to go. But that doesn't mean that investors should ignore bonds altogether. We see good prospects for Asian bonds especially, partly because of the currency kicker. We still see Asian currencies heading higher on the back of capital inflows. So Asian bonds, another asset class to look at in a total portfolio.
Vasu, how does China figure in all this?
I think, so much of negativity about China over the last 18 months. China has been tightening monetary policy. Clearly, that's weighed on the Chinese stock markets. We see China as a buying opportunity. We think that China is coming to the end of its tightening cycle. Inflation is starting to show some signs of easing. The latest inflation numbers came off from 6.5% to 6.2%. The Chinese stock market, in terms of price-to-earnings ratio, is not looking expensive at all. And if the growth holds up and we don't see a hard landing, then China is going to look attractive. Our base case scenario for China is for 9.2% growth this year, but growth could slip to about 8.6% next year on our forecast, but that's still very attractive compared to what you have out of the West. And I think when global investors come to see that and recognize that, I think money will make its way to the Chinese equity markets, and so we're quite positive on China for the medium term.
Vasu, the 3 trillion yuan question, I suppose, has got to be when we saw last week London becoming an RMB offshore centre. It will be one. If I talk to you in a year from now, will we have full convertibility for the yuan?
Well, I think, yes, we're quite positive on the yuan. We see the Chinese government internationalizing the currency gradually. They know that's the way to go. If they want to be a major player in the global arena, they have to allow that to happen. But they'll do it gradually. They'll not want to, rock the boat in any big way. We see possibly 3 to 5% appreciation of the Chinese currency in the short term, possibly even a faster pace when the Chinese authorities become more comfortable. And they know that a stronger currency is good for China as well because, it helps to tame inflationary pressures because a lot of the inflation that's coming out of China is imported inflation. And I think as the Chinese currency strengthens, China will be a force to reckon with in various parts of the world, just as we saw Japan being a force to reckon with in the 1980s with a stronger yen. So I think that's something to bear in mind for investors.
Vasu Menon, thank you so much for joining us from OCBC Wealth Management there.